Walk through certain condo buildings in Florida right now, and you'll notice something that feels the lights are on, the lobbies look clean, the pools are still blue, yet the units aren't moving the way they used to. Not because Florida stopped being Florida, but because the math behind owning a condo here has changed. This isn't a doomsday video, it's not hype. It's a market reality check built around the biggest forces reshaping Florida housing: rising inventory, a sharp slowdown in domestic migration, stricter condo safety requirements, and a financing squeeze tied to insurance. And here's the key question: is Florida replaying 2008, or is it entering a different kind of correction that targets condos first? Let's start with what's easiest to measure: supply. In early 2025, Florida hit a new peak, more than 172,000 homes listed for sale, the highest level since 2012, according to reporting that cited Redfin data. The Tampa Bay area alone had over 24,000 of those listings, and Orlando had more than 17,500. When inventory rises, buyers get picky, sellers lose leverage, and price reductions become normal again, not rare events like during the pandemic frenzy. Now zoom out to what Redfin's statewide dashboard showed later. Florida had 207,179 homes for sale in October 2025, up 3.2% year over year, while price drops were becoming more common. This doesn't mean every neighborhood is crashing. Florida is too big for that. What it means is the market is shifting from seller control to a more normal environment, and condos are where the pressure is showing up first. For years, Florida had a cheat code: people moving in from other states. That demand helped absorb new construction, justified high prices, and made investors feel like Florida could never run out of buyers. But the data says that wave cooled fast. According to U.S. Census Bureau data summarized in reporting, Florida's net domestic migration dropped from 310,892 in 2022 to 183,646 in 2023, then 58,411 in 2024, and then 517 in 2025, a huge decline from the pandemic peak period. A housing market can survive high prices or high rates or high insurance. What's harder is surviving all of it while the demand engine slows. And quick clarification, this is domestic migration, not total population change. Florida still has international migration, but when you remove that big moving from New York, New Jersey, Illinois surge that dominated 2022 psychology, the housing market behaves differently. Resi Club's analysis of census data put it plainly: Florida was around plus 23K net domestic migration in 2025 versus roughly plus 314K in 2022. That's not a rounding error, that's a regime change. When demand cools, inventory matters more, and when inventory rises, sellers compete harder, and when sellers compete harder, the weakest product shows stress first. In Florida, that weakest product is often older condos with rising monthly costs and complicated financing. If you only look at median home prices for the whole state, you can miss what's happening inside the condo segment. Condos don't just compete on bedrooms and location. They compete on something buyers now obsess over: monthly carrying cost uncertainty. Because with a condo, your mortgage payment isn't the whole payment. It's mortgage plus taxes plus insurance plus HOA. And in many buildings, the HOA number isn't stable anymore. After the Surfside tragedy, Florida pushed stronger condo safety and reserve expectations into the market. And even without turning this into a legal lecture, the practical outcome is simple. Many buildings are confronting expensive reality: repairs, reserves, and long-term maintenance funding. Florida's HB 913 became law in 2025, reflecting ongoing state attention to condo governance and building requirements. The point for buyers is not the bill number. The point is the effect. Buyers price in risk. If they think the HOA can jump, they lower what they're willing to pay. And if enough buyers do that at once, condos can correct even if single-family homes in the same metro look fine. Now we get to the part most casual market watchers miss. In Florida condos, the market isn't only about price. It's about financeability. The Palm Beach Post reported that inadequate insurance is a major reason condo associations wind up on Fannie Mae's ineligible/blacklist system, making it harder for buyers to get loans and for owners to refinance. The same reporting cited 1,438 Florida condos listed as ineligible for Fannie Mae-backed loans, with insurance problems frequently cited. Here's why that matters. If a building becomes difficult to finance, demand shrinks to mostly cash buyers. And cash buyers don't pay retail. Cash buyers want terms. They want discounts. They want sellers who are stressed, not sellers who are confident. So even if your unit looks beautiful inside, the building's insurance and documentation can quietly reduce your buyer pool. And when your buyer pool shrinks, time on market rises, price reductions rise, and the empty condo feeling grows. Not always because nobody wants Florida, but because the deal structure stops working for normal buyers. Let's talk about South Florida because it's not one market, it's multiple markets stacked together. ARN's reporting described a mixed start to 2026 across the three biggest counties. In Broward, the median condo/townhouse price fell 2.8% year over year in January to $250,000, and inventory increased from late 2025 lows. In Palm Beach County, condo sales rose 8.7%, even as inventory increased, and cash buying remained a major feature. WLRN cited that 2/3 of condo sales close in cash. And in Miami-Dade, WLRN noted the median condo price holding around $420,000, with inventory rising, suggesting a buyer's market dynamic, while luxury sales influence the stats. That's exactly what a transition looks like, not a uniform crash, more like a market sorting itself into tiers. Tier 1, prime, financeable, well-run buildings and luxury cash markets. Tier 2, average condos where buyers negotiate hard. Tier 3, older, higher-risk buildings where monthly costs and financing questions dominate everything. Whenever ownership gets messy, people rent longer. And Florida has seen a lot of new multifamily supply over the past cycle. Look at Jacksonville as an example. Cushman and Wakefield's market beat for Jacksonville multifamily Q2 2025 reported effective rents around $1,515, down 1.1% year over year, while the market worked through elevated recent supply and slower in-migration compared to the earlier surge. They also noted stabilized occupancy around 91.0% and described how large inventory growth since 2020 and moderating in-migration extended lease-up timelines. Why does rental softness matter to condo owners? Because rent levels anchor investor math. If rents flatten or dip while HOA plus insurance rise, the investor buyer disappears or demands a lower price to make the numbers work. That's another way condos can correct first, not because nobody wants to live there, but because the investment equation breaks. Let's address the obvious comparison. In 2008, Florida became a symbol of the housing bust, overbuilding, speculation, and financing that collapsed. Today, there are parallels in the field: rising inventory, slowing demand, price cuts, and anxiety. But the mechanism is different. The big story now is not just loose lending, it's affordability plus carrying costs plus financeability. Inventory rising matters. We already saw Florida hitting over 172,000 listings, a 13-year high per reporting tied to Redfin. Demand cooling matters. The domestic migration numbers are undeniable: 310,892 2022 down to 22,517 2025 in the same reporting. And the condo financing situation matters, with buildings facing loan eligibility problems linked to insurance adequacy and lender requirements. So if you're asking, is Florida doomed? That's the wrong question. The better question is, which parts of Florida housing are exposed to the new reality and which parts can adapt? If you're shopping for a condo in Florida, your advantage is simple: options. More inventory means more negotiating power, but you have to buy smart. Your checklist now needs to include building-level risk, not just unit-level features. Ask questions like, do buyers in this building regularly get conventional financing approved? Are there known insurance or documentation issues that slow down closings? Is the HOA stable, or has it been rising fast? Because in a condo market, the building is the product just as much as the unit. And if the building can't clear financing hurdles, you might get a great price that becomes a resale problem later. Exactly the dynamic described when condos become ineligible for Fannie-backed lending due to insurance-related issues. If you already own a condo, the priority is clarity. In this environment, you can't treat HOA notices like junk mail. You need to understand the building's financial direction, because buyers will, and you should assume the market will, reward transparency and punish uncertainty. If your building is well run and financeable, you'll compete fine. If it's not, the market can discount you, even if your interior renovation is perfect. And remember, when inventory rises statewide, stale listings become common. That was the exact warning tone from Florida real estate professionals when the state passed the 172,000 homes listed milestone. If you're investing, Florida condos are no longer a simple rent it out and chill trade. You need margin for HOA increases, insurance volatility, slower resales, and financing friction. And you should watch rent trends with the same intensity you watch sale prices. Jacksonville's multifamily market, for instance, showed minus 1.1% year-over-year effective rent change in Q2 2025, while also discussing supply pressures and moderating in migration. When rents soften and costs rise, cap rates compress the wrong way, meaning your exit price has to fall to make the deal attractive. That's how corrections happen without a headline crash. It's slow, it's building specific, and it's driven by math. Here's the simplest way to understand Florida right now. Florida didn't suddenly become undesirable, but the pandemic-era housing story, where demand seemed infinite and costs felt manageable, has changed. Inventory surged to a level Florida hadn't seen in over a decade. Domestic migration, the thing everyone assumed would keep absorbing supply, downshifted massively from the 2022 peak. And condos face a unique squeeze, building costs, reserves, and insurance-driven financing restrictions that can shrink the buyer pool and force cash discount pricing. So no, this isn't automatically 2008 again. But yes, this is the kind of transition period where people who ignore data get hurt, and people who understand segments find opportunity. If you're in Florida, buy, renter, owner, or investor, drop a comment with your county and what you're seeing. More listings, price cuts, slower sales, HOA jumps, or insurance shocks. The boots on the ground reality is often the earliest signal.